Hello everyone, welcome to Brilliant Bankers. In today's session, we will be discussing on the topic Treasury Risk Management, the nature of risk in the banking business, and the conventional tools for management and the control of risk, the different type of risk measures that are being taken, and the way they are being used. To like the video, if you find it worthy, do not forget to comment on the video, subscribe to our channel, Brilliant Bankers. Also, do not forget to press a notification bell to get the notification of the upcoming videos. Let's proceed to our session today. So, the importance of risk management. Treasury risk management in the banking sector involves the identification, assessment, and control of various risks associated with a bank treasury operations. The treasury function in a bank is responsible for managing the institution's financial resources, like that of the liquidity, interest rate risk, foreign exchange risk, and other market risks. Effective treasury risk management is crucial for maintaining the financial stability of the bank or the treasury, complying with the regulations, and also optimizing the bank's overall performance. The nature of the treasury activity is such that the profits are being generated out of the market opportunities and the market risk is present at each and every step during the process. Treasury is also responsible for the balance sheet management. So, in summary, effective treasury and risk management in the banking sector requires a comprehensive approach that considers various types of risks and employs a combination of risk identification, measurement, monitoring, and control strategies for which the banks need to adapt to the changing market conditions, the regulatory requirements, and the technological advancements to maintain resilience in the face of the evolving risk. So, what are the main concerns of the treasury risk? Bank management is highly sensitive to the treasury risk, as the treasury risk management in banks involves addressing a range of concerns to ensure the stability and the profitability of the institution. So, some of the key concerns are like high leverage, wherein there is a exchange risk, large size of transaction, wherein there is a liquidity risk, variation in the market price, the market risk, the credit risk, systematic and unsystematic risk, and the operational risk. So let's go through all these different type of concerns in the treasury risk. Taking the case of the liquidity risk, it is the inability to meet the short-term obligations due to the insufficient liquid asset. For example, if a bank experiences a sudden surge or a sudden increase in the withdrawal of deposits or faces difficulty in accessing the interbank lending market, it may struggle to meet its immediate funding requirements. So, this is what is called a liquidity risk. The interest rate risk, it concerns the adverse impact on earnings and capital due to the change in the interest rates. For example, a bank that predominantly holds long term fixed rate assets may face losses if interest rate rises as the market value of those assets may decrease. This is particularly relevant for banks with a maturity mismatch between the assets and the liabilities, wherein the deposits mature earlier than that of the loans that has been given in the bank. So in this case, there is always a difference between the assets and liabilities, for which the ALM, the asset and liability management group, has to take care of the case. The exchange risk or the foreign exchange risk, it concerns the exposure to losses due to changes in the exchange rates. A bank with significant foreign currency denominated assets or liabilities may face losses if exchanges rate move unfavorably. For instance, if a bank has issued loans in a foreign currency and that currency depreciates, the value of the loans in the bank reporting currency will also decrease. Coming to the variation in market prices or the market risk, potentially losses in trading and investment portfolios due to the market price movements. So, whenever there is change in a market price, there are chances for losses, and the chances, if the prices decrease, the chance for the loss is high. For example, a bank with a large portfolio of equities may face losses if there is a significant downturn in the stock market. Effective risk management involves the diversification and using of derivatives to hedge the position and regularly assessing the market risk exposure. So we will be learning about the derivative part of the treasury in the next chapter, which is a full lecture on the same thing. Coming to the credit risk, this is by the default by borrowers or the counterparties, leading to the financial losses. If a bank has a concentrated exposure to a particular industry and that industry experiences a downturn, the bank losses portfolio, the bank's loan portfolio could suffer significant losses. The credit risk management involves thorough credit analysis and setting appropriate credit limits and also diversifying the loan portfolio. What is an operational risk? Wherein disruptions or losses resulting from the inadequate internal processes or systems due to which an operational risk can happen. A bank might face an operational risk if there is a failure in its IT systems, leading to the service disruptions or the data breach. So, operational risk management involves the implementing of robust internal controls and conducting regular audits and having the contingency plans in plan to clear it whenever there is some kind of risk that is coming out. So, addressing all these concerns requires a combination of the risk assessment, the strategic planning, and the implementation of the risk mitigation measures. Banks often use all these models, the risk models, the stress testing, and the scenario analysis to evaluate and manage these risks effectively. Additionally, ongoing monitoring and adaptability to changing the market conditions are the most essential aspects of the treasury risk management in the banks. So, how is the management of the treasury risk done? The treasury risks are primarily managed by the conventional control and supervisory measures by preventive steps like that of the organizational controls, exposure ceiling, and the limits in the trading positions and stop loss limits. Normally, in treasury risk management, various organizational controls and risk limits are established to ensure that a financial institution operates within the acceptable limit and the risk parameters. These controls help manage and mitigate the risk associated with the activities such as trading, investment, and also the treasury operations. So, when going or diving deeply into the organization controls, what does an organization control mean? It refers to the policies, procedures, and the governance structure put in place by a financial institution to manage and monitor its activities, particularly those related to the treasury funds. Like that of the front office is being headed by the chief dealer, the back office is responsible for confirmation, accounting, and the settlement of the deals, and the mid office is responsible for the risk management and the management of the information system, wherein all these controls come together. The internal controls, which are the most important of the position limits and the stop loss limits also. This is also being controlled by the organization control. So the main purpose, these controls are designed to ensure that the institution operates in a compliance with regulatory requirements, internal policies, and risk appetite. They also help establish a framework for the risk management and provide guidelines for decision making. For example, a bank may establish a comprehensive set of policies and procedures governing its treasury operations, including the guidelines on risk assessment, risk reporting, and the internal controls. Regular audits and the compliance reviews ensure adherence to all these controls. So, what is the exposure ceiling? An exposure ceiling is a predefined or the predetermined maximum level of risk or exposure that a financial institution is willing to accept in a particular area or for a specific type of risk. That is exposing the bank itself to a specific type of risk. That is a exposure ceiling. Exposure ceilings are set to limit the overall risk exposure of the institution, helping to prevent excessive concentration in any one area. They are typically defined for various types of risk, such as the credit risk, market risk, and the operational risk. These ceilings are often established based on the institution's risk tolerance and the regulatory requirements of the institution. For example, a financial institution might set an exposure ceiling for its credit risk, limiting the total amount of credit extended to a particular industry or a borrower. This helps in prevention of the over concentration of the credit risk, that is, minimizing the credit risk by lending only a limited amount for a particular industry. What are the limits on the trading positions or the limits in trading positions and stop loss limits, which are taken in a combined way? Coming to the point limit on trading positions, these are the specific restrictions on the size or the volume of the financial instruments that a trading desk or a department within a financial institution, that is a treasury, the front end of the treasury, is allowed to hold. These limits are implemented to control the level of market risk associated with the trading activities. Whenever a bank might set limits on the size of positions in the particular currency, commodity, or other financial institutions to ensure that the institution is not exposed to excessive market volatility. For example, a currency trading desk may limit or may have a limit on the size of the position it can hold in a specific currency to control foreign exchange risk. For instance, the limit could be set as a percentage of the total trading capital. Coming to the main point, the stop loss limits, which is to be taken with high care. The stop loss limits are predefined levels at which a financial institution or a bank will automatically exit or reduce its exposure to a particular position or investment. These limits are designed to limit potential losses in the event that the market moves against the institution's position. When a specific threshold is reached, the system triggers an automatic action to sell or reduce the position, helping to prevent further losses. These limits or the stop loss limits are commonly used in trading and investment activities to manage the downside risk. In the context of a bond portfolio or a equity share, a fund manager may set stop loss limits for individual bond holdings. If the price of the bond falls below a certain amount, the manager may automatically sell the bond to limit the future potential losses. These controls and limits are integral components of the robust treasury risk management framework. So, contributing to overall stability and the resilience of a financial institution, they always help strike a balance between the pursuing profitable opportunities and maintaining the risk within the acceptable boundaries. So now comes the same topic, market risk, which we have already discussed earlier also in the previous videos, but we'll be going through a brief idea of what is market risk in this chapter also. So in simple terms, it refers to the possibility of the financial losses arising from changes in the market prices. It is a risk that the value of financial instruments or assets held by an individual or an organization will decrease due to the market fluctuations. There are several types of market risk, like that of the liquidity risk, interest rate risk, exchange rate risk, equity risk, commodity risk. also. They are also known as the price risk. The market risk is also known as the price. The main components of the market risk are the liquidity risk, the interest rate risk, and the currency risk. So let's go through these main components. The liquidity risk is the risk which is of not being able to sell or buy an asset quickly without causing a significant impact on its price. So, in the case of the liquidity risk, we will not be able to buy or sell an asset as quickly as we expect or without causing a significant impact on the price. That is, till the time there is some reduction in the price. So, this is called a liquidity risk. In case of an example, if a stock is illiquid, meaning there are few buyers or sellers trying to sell a large amount of that stock, then it may quickly result in a lower price than expected. So, where a liquidity risk is arise. Coming to interest rate risk, this is the kind of risk of losing money due to the changes in the interest rate. Imagine that you own a bond that pays a fixed interest rate. If the market interest rate rises, the value of your bond may decrease because new bonds with higher interest rates become more attractive to the investors. So, this is what is called a interest rate risk. What is a risk or a foreign exchange risk? The currency risk is also called a foreign exchange risk. This is the risk of losing money. This is the risk of losing money due to changes in the exchange rates. Suppose Suppose yourself as an investor holding stocks in a American company. If the value of dollar weakens against the Indian rupee, the value of our investment in US also may decrease. So this is what is called as a currency risk. All in all, whatever we have seen in this topic, the market risk, the main understanding and managing of the market risk are crucial for investors, businesses, and financial institutions to make informed decisions and protect the financial well being. Also, diversification, hedging, and risk management strategies are commonly employed to clear off or mitigate the impact of the market risk. So, what are the different kind of measures that are being used for mitigating the market risk? The different kind of measures that are being used or the way to measure the risk are the VAR and the duration. What is a VAR? VAR. That is a value at risk. This is a widely used risk measure that quantifies the potential loss in the value of a portfolio over a specific time horizon and at a given confidence level. In a similar term, it answers the question, what is the maximum amount of loss I could lose in my portfolio over a certain period with a certain level of confidence? So, automatically, value at risk is the way how we calculate the maximum amount of money that we are going to lose in our portfolio over a certain period of time with a certain level of confidence. How is the calculation of VAR being done? It is by determining the time period for which the VAR is to be calculated. It may be a day or a week. We also choose the confidence level that is decided on the confidence level, typically expressed as a percentage, whether how confident we are that the level will not be changing, whether it is 90%, 95%, or 99%. Example 95% VAR means we are estimating that the maximum loss with 95% confidence. For instance, in an overnight VAR of 45 paisa for the US dollar to INR rate at 95% confidence level implies that there is only 5 chance of the rate going below 45 paisa next day. Well, if today's spot price is rupees 95, which is not that. If today's spot price is rupees 95, tomorrow the worst possible rate for exports can be assumed at 94 rupees 55 paise. So with reasonable safety, there is only 5% chance of the rate being worse than that of 94.55. It is also by gathering historical data on the portfolio's returns or the relevant market factors. If your portfolio includes multiple assets, we calculate the portfolio returns based on the historical data and weight of each asset by arranging the historical returns in the ascending order, and also by finding the historical return at the chosen percentile corresponding to the confidence level. For example, if we choose a 95% level, then we should select the return at the fifth percentile. So why is that fifth percentile being used here? Because whenever we are choosing a 95% confidence level, then the fifth percentile is being used, because 100 minus 95 is 5. Calculating the VAR. The VAR is a negative value of the return identified as a chosen percentile. It represents the estimated maximum loss at a given confidence level. So suppose an investor in India holds a portfolio of stocks with a market value of 50 lakh. The investor wants to calculate the one day VAR at a 95% confidence level. So he is just going for a period of one day. He is having a confidence level of 95%, and he has gathered the historical daily returns for the portfolio considering the Indian stock market indices and the individual stock prices. To calculate the daily returns based on the historical data, and to order the daily returns from the lowest to the highest. This is how they are going to place it. To identify the percentile at a 95% confidence level, we look at the return at the fifth percentile. The VAR is the negative value of the return of the fifth percentile. So suppose the return of the fifth percentile is minus 2%. Then VAR would be rupees 50 lakh multiplied by 2%, which is 1 lakh rupees. This means there is a 5% chance that the portfolio could lose up to 1 lakh in a day with 95% confidence. So, what are the limitations of the VAR? The VAR assumes that the market conditions remain similar to historical data, and it may not capture the extreme events or changes in the market dynamics. Additionally, VAR does not provide information about the tail risk beyond the chosen confidence level. So, what is the other way to measure the risk? It is duration, which is widely used in the investment business. Through the concept of duration is applicable to all assets and liabilities where interest rate is present. To understand the duration, we need to be familiar with the concept of the YTM, or the yield to maturity of a bond. Treasury invests in the government securities and non-government securities of various descriptions, like that of the bills, bonds, and debentures, which we will be mentioning as a bond in the whole lecture. So, what is duration? Duration is a measure of a bond's sensitivity to the interest rate changes. It provides an estimate of the average time it takes for the bond's cash flows, that is, the interest and the principal payments to be repaid. Duration is a crucial metric for assessing interest rate risk in final fixed income investments. So, what is a modified duration? This is the measure of the bond's price sensitivity to interest rate changes. And how do you interpret it? Duration is expressed in years and represents the average time it takes to recover the investment in a bond. A higher duration indicates the higher interest rate sensitivity. And what are the limitations in duration? Duration assumes that the interest rates change uniformly. Duration assumes that the interest rates change uniformly across all maturities, which may not be the case in reality. It also does not account for changes in cash flows due to the factors other than that of the interest rates. So, totally in practice, both the VAR and duration are valuable tools, but they should be used in conjunction with the other risk measures to provide a more comprehensive understanding of a portfolio's risk profile. So, these are the two tools that we are learning in our subject today or session today. Coming to the use of derivatives. What are derivatives? They are the financial contracts to derive the value based on a underlying market for a commodity or a financial product. These are used to protect transactions from the market risk. We will be going for a detailed study of the derivatives in the next chapter, wherein we will be going through the topic, the derivative products. So let's continue this topic in the next session. If you have any doubts or queries, please feel free to leave them in the comment section below. Your feedback is invaluable to us. With that, we come to an end of today's session, and we have discussed about the Treasury Risk Management, the types of market risk, and the ways and means to measure the market risk. Do not forget to subscribe the Brilliant Bankers. Do like the channel and share it with your friends. Have a great day. Jai. Duration assumes that the interest rates change uniformly across all maturities, which may not be the case in reality. It also does not account for changes in cash flows due to the factors other than that of the interest rates. So, totally in practice, both the VAR and duration are valuable tools, but they should be used in conjunction with the other risk measures to provide a more comprehensive understanding of a portfolio's risk profile. So, these are the two tools that we are learning in our subject today or session today. Coming to the use of derivatives. What are derivatives? They are the financial contracts to derive the value based on a underlying market for a commodity or a financial product. These are used to protect transactions from the market risk. We will be going for a detailed study of the derivatives in the next chapter, wherein we will be going through the topic, the derivative products. So let's continue this topic in the next session. If you have any doubts or queries, please feel free to leave them in the comment section below. Your feedback is invaluable to us. With that, we come to an end of today's session, and we have discussed about the Treasury Risk Management, the types of market risk, and the ways and means to measure the market risk. Do not forget to subscribe the Brilliant Bankers. Do like the channel and share it with your friends. Have a great day. Jai.